Welcome to Inside India. I'm Amitabh Singh, and these are your headlines. Asia markets continue to climb as expectations for a Fed cut gain momentum. U.S. Treasury Secretary Scott Bessent telling CNBC that President Donald Trump may decide on the next Fed chair very soon.
I think that there's a very good chance that the president will make an announcement before Christmas, but it's his prerogative whether it's before the Christmas holidays in the New Year's, but things are moving along very well.
Plus, India may be considering extending its safeguard duties on steel to counter cheap imports. And Alibaba shares under pressure despite an earnings beat, cloud growth, and quick commerce gains. From e-commerce to quick commerce, we'll take a deep dive into India's evolving retail landscape with the CEO of India's V2 Retail and Macquarie Capital coming up on the show. All right, hump day without trading in the U.S. on Thanksgiving and the second half on Friday. A look at Asian markets right now. Take a look. Asia-Pacific markets clearly seem to be following gains at Wall Street, all in the green, apart from the Shanghai Composite, which just went on the red as I was speaking. All right, then, thanks so much for that. But clearly, a lot of positive vibes coming in from the U.S., from PPI data and retail sales data, appearing to support that Fed cut, hopes in December. More on that later. And then the latest from Treasury Secretary Scott Bessent suggesting what we told you just a short while back, that U.S. President Trump could name a Fed chair pick by Christmas. New Zealand central bank with a hawkish rate cut. That's had an impact. Australia's ASX and S&P 200 was trading about 1.2% higher right now at 0.84% higher on inflation data. The country's inflation accelerated in October, beating analysts' estimates and rising at its fastest pace in 7 months. And there's also that UK budget to watch out for 2025. It is today, the budget to see whether the UK government can actually combine fiscal discipline and economic growth without spooking markets. At this point in time, the Nikkei really dominating at 1.94% and the Kospi supporting at 1.82%. Now, the Indian markets, they come online in about 45 minutes. Here's what GIFT Nifty futures are indicating. The Nifty had a volatile trading session on Tuesday, ending about 100 points lower, losing ground for the third straight session. At this point in time, a muted start is what it's indicating. Among sectors that we'll be watching are Realty and PSU banks indices, because they underperformed just yesterday, both rallying nearly 1.5%, whereas the media index, it lost the most, shedding nearly 0.70%. Remember, lower interest rates in the US make emerging markets such as India more attractive for foreign investors. And we've kind of seen that. Foreign portfolio investors, they turned net buyers of Indian stocks on Tuesday after 2 sessions of outflow. A renewal of steel safeguard duties, in other words, India's own tariffs on other countries, are being considered, according to reports, and that may also have an impact on the market. We're watching the US dollar-India rupee relationship also very closely at this point in time. The Indian rupee weakening, the dollar strengthening, and the 90 figure really is what we're watching out for. Now, one of the stocks we're tracking right here in Asia is Alibaba, after the Chinese tech giant posted an earnings beat. But the stock is under pressure today. Let's bring in Emily Tan. Emily, what's up?
Hi there, Amitabh. Good to see you. And the report card coming through from Alibaba, and it's a bit of some downside that we're seeing in the stock. So this would mirror the losses that we had in the ADRs overnight, but maybe also to do with the fact that we had a recent run-up in the stock, just from the fact that the company launched its consumer-facing Qwen chatbot and releasing and disclosing that they had 10 million downloads in just the first week alone. So that really ramping up the stock, and so maybe some profit taking that is setting in today. But the report card was a beat on both the top and bottom line. Revenues of $34.8 billion, up 5%. Income was dragged down on spend for maintaining market share in its commerce space, in the commerce business, and of course for AI infrastructure as well. They're focused very much on instant retail, and they're pouring billions into that to capture market share. They're also investing heavily into that of artificial intelligence. Earlier on in the year, they've put in 53 billion, or had amounted, or basically allotted 53 billion over the next 3 years. And Eddie Wu, CEO, saying that this amount might be small given customer demand. He's dismissed concerns about an AI bubble, saying that they plan to explore aggressive investment in order to keep pace with market demand as well as competition. I had the pleasure of sitting down with Joe Tsai when we were back in October in Macau for the NBA basketball games. Also took some time to ask a little bit about artificial intelligence and the spending that they're doing there in this space and up and coming industry. This is Joe Tsai speaking about AI spend.
I absolutely share Eddie's enthusiasm for the future of AI, because just in the last couple of years, we see potential demand for AI growing in our home market in China. And there's a couple of things going on uniquely in China that's I don't think you see elsewhere in the world. Number one, there's a proliferation of consumer applications. China, as you know, is a country where from e-commerce to social networking to mapping apps to food delivery, there's consumers always online on their mobile apps, mobile payment, right? And so you have now AI-enabled applications that is really delighting the consumers, and it's really catching on. The adoption rate is very, very fast. So that's number one. The number two thing is, I think is also unique to China, is China is a big manufacturing base. 30% of world industrial production comes from China. So to develop good AI, you need to have good data. So where can you find all the great industrial data? It's in China. And we think in the future, the manufacturing sector in China will really benefit from the adoption of AI. So I think in the future, you'll see, you always have this sort of debate of who's going to win the AI race. I believe having large adoption is the most important thing in terms of benefiting from AI.
Alibaba and using AI for their customers. This is Quen, their chatbot, as well as their e-commerce business, and AI technologies helping to drive consumer engagement as well as personalizing that shopping experience, also helping to make things go faster. Amitabh, Alibaba having instant commerce as well. I know this is something that you're looking into. In China, instant commerce is delivery within 1 hour. Back to you for now.
In India, it's within 10 minutes. You guys got to catch up. All right. But thanks so much for that, Emily. I'm just jealous you were on the basketball court. But let's talk about that quick commerce theme. India is really emerging fast as a global quick commerce powerhouse. Statista projects India will be the third largest market by revenue in 2025, behind China and the US. So yeah, we're behind. But ahead of Japan, South Korea, and the UK. Revenues are expected to jump from over $5 billion in 2025 to more than $11 billion by 2030, raising India's global share from 2.7% to 4%. Now, India is also set to be the fastest growing among the top three, with a compound annual growth rate of 15.5% between 2025 and 2030. This is more than double the pace of the US and China. On the ground, though, leading players like Blinkit, Zepto, Instamart, Flipkart, there are a few more. Big Basket, they're already expanding across 70 to 100 cities, fueling India's rapid rise in quick commerce. But are there concerns? And that's why we've got Aditya Suresh. He is the head of India Equity Research at Macquarie Capital. Aditya, I really appreciate you coming on. You heard what Emily was talking about, Alibaba, AI. One of the things that's been said a lot in AI is that momentum is the moat. And I want to ask you, is that how you can describe India's quick commerce space at this point in time?
I think that's definitely a mindset for the operators, where you are kind of in the phase of expanding your physical footprint. So you're expanding the network of your dark stores. You are kind of looking to, there is a land grab and a dynamic which is at play. As you pointed out, this is all in a 10-minute kind of delivery format, not the 1 hour. There are specific issues with the way that the model is developing, but today the mindset for the operators is that, and there are multiple operators, it's not just the likes of a Blinkit and an Instamart and a Zepto, but you do have competition emerging, right? Whether it be the horizontal platforms, whether it be the the physical retail kind of players, there is a lot of competition in the space. And but the mindset today is more about expansion and driving GMV momentum. So when you put up say 15-16% kind of GMV growth, some of the GMV growth numbers which you're seeing on a real-time basis is north of 100% as you're kind of expanding into newer cities, so on and so forth. But we can discuss that. But the broader mindset is about expansion for the operators.
Okay, so just dive a little deeper into the phrase that you use. There are issues.
Yeah, look. So I think so we've done a lot of work on the topic, and one of the recent notes which we published was that is this a field of dreams? Therefore, the big kind of underpenetration retail capture opportunity, or is a Pyrrhic land grab? So if the frame and the lens, and I have huge respect for these companies and what they're trying to do, but if the frame and lens is about kind of capturing GMV, they're doing that really well. If the frame and lens is about that GMV has to translate to some economic profit at some point in time, that's kind of where at least we struggle with when we kind of think about the first principles and the math. And the real specific problem statement is that this is a physical retail inventory turn business with a delivery cost obligation. And what competition really does is that, and this is again at a specific micro market, it has to be kind of measured and monitored. What competition basically does is that it drives down, or at least puts downward pressure on the throughput of your said dark store. And therefore, the costs going to go up, right? Or the ability for you to kind of get to a state where you are fully utilized from a dark store order throughput perspective is minimized. And that's the real problem here, right? Which is that when you think about the underlying cost in itself, even the more efficient operator is loss making. Someone like a Swiggy and an Instamart, at the time of the IPO, the EBITDA loss was -10. Today, the EBITDA loss is at -12, as they've kind of expanded the network. To contextualize that, even, for example, with Instamart, you are kind of at a contribution level, still kind of losing money. And even when they get to, say, contribution break-even, the loss you're looking at next year is about, say, $500 million. So the real point about the story is that, yes, there is a land grab kind of mindset here right now,
Right.
but the economics of this requires benign competition. And the phase we're in right now is one where competition is hitting this model from multiple different dimensions.
Okay. I just want to zoom out a little bit because you've given a lot of numbers and you've spoken about economics, right? But at the end of the day, it's also about consumer sentiment. Consumer sentiment, if I can describe it, is simple. Delhi is, has a lot of traffic. Mumbai has a lot of traffic. These big cities, Bangalore is, famous for its traffic, infamous rather. If my family is ordering, right, they are like, I don't want to go out. I just want to order in some food. Or I want to order in this particular thing that I'll have to go to a shop for. And that's their mindset. And they're going to save a lot of time. They don't mind paying a little bit extra, right? This is lower middle class, this is middle class, this is upper middle class, this is the rich. And you can correct me on that. You're in Mumbai, so you can tell me. So is it possible that your economics are not factoring this in entirely? Because that's usually what happens, right? You go by the numbers, you have to go by the numbers, but there's a sentiment on the ground too.
No, I mean, the sentiment on the ground is speaking to the product market fit for quick commerce as a category, right? So there is a lot of GMV growth, which is present. Now, the problem again is that the charge a little bit or pay a little bit is insufficient to cover the cost of running the operations. And that is more, and that again has to be viewed in the context of specific micro markets, the cost of setting up a dark store, the cost of maintaining, managing, turning that inventory in the dark store. And again, so it's like, for example, you've seen this entire dynamic of the gig workers. The government is looking to kind of protect the gig workers, bring in social security, these type of dynamics. All that is inflationary, right? And so the cost side of the equation, Amitoj, is really problematic. So you will have a certain section of dark stores, let's say top 10%, 20%, where the economics works. But there is a huge long tail where the economics does not work, right? And that's a challenge here for these operators.
Okay, I have a couple of questions and we're completely running out of time. So let's just try to do this a little faster, right? You've said this, I hear you, but look at this. There's a buy call at about 16% according to Bloomberg. overweight, the following are overweight: Morgan Stanley, Citi, and Bernstein on stocks that represent quick commerce, the Zomatos and the Swiggies. So how do you, like, you're differing in an opinion, right?
Yeah, so where we are different from consensus is that consensus view is underpinning a sharp turnaround in economics for quick commerce. So basically from losses towards a meaningful positive state on profit. We disagree with that opinion because of what I said on the cost dimension of quick commerce. So you may get GMV, and if you're pricing the EV to GMV, the math may work, but if it's an economic profit, the math does not work. So where we are different is the economics of quick commerce, and we think the losses are going to persist for the next several years, not just 1 year. And then in the base food delivery business, that's a good business, but growth is below consensus, and also we do see kind of medium-term kind of downside here on take rates. So both the base business, food delivery, and quick commerce, we're materially different from where the consensus views at.
Okay, that's significant, really. That is very significant. How do you factor in the discount wars? Because we're likely to see that this is going to affect quick commerce a lot. You've kind of indicated to it. Just dive deeper into it, because profitability and growth concerns have been flagged in the past by you, and these deep discounts do come at a steep cost.
And that's a problem again for this model, right? So when you think about, say, the number two player, when they kind of just raised capital recently, step one of kind of what did they do was kind of think about lowering commissions, right? So zero commission, zero delivery fees, discount on MRP. So that's your revenue line, right? And that was your point about I may be willing to pay a little bit, but these platforms are like, it's okay, don't pay too much. But there is a big kind of cost obligation here in the backdrop to kind of to kind of absorb. So that's the real challenge here, right? So if you're thinking about transacting users and kind of driving transaction frequency, the phase we're in right now is a bit more problematic for that ecosystem, because any incremental capital is going to be used towards driving engagement. Earlier, that capital might have been used towards driving customer acquisition. That phase is done. Now the kind of problem statement is that you're going to see more competition here on discounting, on commissions, on the how much you're charging the consumer for delivery fees, these type of things. So the revenue function is challenged.
Right. For our international viewers, there's always this interesting story that comes up. Wait, have Amazon and Reliance really started to battle it out yet? Or are they just warming up?
Look, so I think the Amazon story is interesting, and that's an Amazon horizontal kind of e-commerce, but Amazon now is live, right? And so it's interesting to kind of note that these large horizontal platforms moving more towards kind of last mile, optimizing the last mile, right? Whereas you have the players like these quick commerce first kind of apps moving the other direction. So we'll see kind of where this model kind of evolves. The Reliance example is really interesting, because in theory, the Reliance example should mean that I have already an existing physical footprint. Whatever cost I have to fulfill this order is purely a variable cost. All the kind of challenges we spoke to you about in terms of running the dark store, throughput per dark store, all that stuff. That's a sunk cost in the case of Reliance, or any kind of physical retailer with a large presence. Right? So I think Reliance is a potential meaningful player here. They've articulated fairly big ambitions in the space. Growth via JioMart is a big part of the entire Reliance retail growth function in the medium term. So yeah, but at least with Reliance, it's a sunk cost, and you're not burning capital whilst you're trying to gain market share in quick commerce. They're not even doing quick commerce as much as they're doing faster delivery.
Yeah.
So formats are also kind of evolving. Yeah.
Yeah, but the Swiggies and the Eternals are doing 10-minute. These guys are doing about 2 hours or a day, which is interesting. But that's what I meant. They probably will be thinking, or are in some capacity already thinking about that 10-minute kind of delivery system. Just zooming out a little bit, because we got these numbers from Statista, which are fascinating, that India is now the third largest market in the world for quick commerce, and it's behind China and the US, but it's ahead of Japan, South Korea, and there's a lot of funding still coming into India. In fact, it's beating some of the other big nations, and it has that advantage of dense population, which is making it easier to do here in India, but not in the rest of the West. I just want to get your outlook on where India's quick commerce, journey relative to the US and China will be in, say, about 5 years.
So purely from a top-line perspective, these numbers could be very large, right? So again, coming back to the framing of this is that, so when you think about in broad terms, India retail is about $1 trillion, grocery is about $600 billion, quick commerce as a category is, let's say, 2% of that, right? Now, if you're going to take a view that the entire kind of retail pie is kind of expanding, and then share of quick commerce is going to go from, say, 2% towards 5%, contingent on the availability of kind of external capital and funding, you could have some very large numbers, right, in terms of what the size of GMV is for India. So that's a separate dimension, Amitoj, in that. So that's more a question about formalizing a part of the kind of grocery kind of value chain.
Right. Sorry, we're completely out of time. Yeah, no, I hear you. We're completely out of time. I just want a 30-second answer, perhaps even lesser. Is there value on the table left in quick commerce related stocks for you?
We have a fundamental sell call on the listed companies in that space.
Okay. Thank you so much. That was Aditya Suresh from Macquarie Capital. Much appreciated for that insight. We'll take a short break. We're back in 2. Welcome back. This is Inside India. Oil markets losing ground overnight ahead of a much-awaited OPEC decision this weekend, where the oil producer bloc will likely leave output levels unchanged as geopolitical factors weigh on future supply. The group had paused its recent path of supply restoration due to some concern over demand in 2026, which has been challenged, and with the fate of Russian supply still very much in the air. The group is expected to leave production quotas unchanged this weekend. Oil markets regaining a fraction of the overnight losses in Asia trading right now. And India may extend an import tariff on some steel products, also known locally as a safeguard duty, according to reports. It would be aimed at countering cheaper shipments, mainly from China. Officials say the safeguard duty could run between 11 and 12%, extending a temporary 12% levy that expired earlier this month. India, the world's second largest crude steel producer, has already seen finished steel imports drop more than 30% this year. South Korea remains the top supplier, followed by China, Japan, and Russia. The government has yet to confirm these details, but sources warn Chinese steel exports continue to leave India vulnerable. All right, U.S. Treasury Secretary Scott Bessent hasn't revealed any details about India and the U.S. when it comes to tariffs, but speaking to CNBC overnight, he defended the administration's trade dealings with Beijing, despite some reports that the Chinese side plans to buy far fewer U.S. soybeans than was previously thought. Here's more from that interview.
The Chinese are right on schedule in terms of the cadence of their purchases. Over the next 3.5 years, we're going to see the 87.5 million metric tons purchased by the Chinese, minimum, and they are right on schedule.
Scott Bessent also posing some fundamental questions about the current status and possible future role of the Federal Reserve, and his comments coming at a time when expectations for a rate cut next month have continued to rise over 80% now. Data overnight added more legitimacy to the Fed's likelihood of a 25 basis point cut at the December meeting, as producer prices in the United States rose slightly slower than expected, signaling that wider wholesale inflation could be under control and paving the way for a possible Fed easing. Now, this data pushing the CME Watch tool, Fed Watch tool, to around 84%, a far cry from around 40% last week. Also, the New Zealand dollar is strengthening sharply despite the RBNZ cutting rates by 25 basis points as expected to a 3-year low. But it was a hawkish cut, the central bank signaling that this may be the end of its easing cycle as it sees signs of a pickup in growth. The RBNZ governor saying they're seeing signs of stabilization in the labor market in what's been a challenging year and an improvement in all high-frequency indicators. The RBNZ has cut rates by 325 basis points since late October to shore up its weak economy. Also, Chancellor Rachel Reeves in the UK is attempting a moonshot budget with a very fine line to walk between stabilizing the economy, attempting to return the UK to growth, and not really, managing the disillusioned sentiment amongst the people. Widespread tax hikes appear to be certain, and the question is if the financial markets decide that the Chancellor is skilled enough to guide the government's fiscal imperatives during these tricky times. The budget will be announced later today, with markets remaining on a knife edge. We're watching that very closely here on CNBC. Coming up, we take a closer look at India's V2 retail, the value fashion retailer that's been making waves with rapid expansion and strong growth across the country. Stay tuned. Inside India, we'll be right back. Welcome back. Now let's get a quick check on how Asia markets are doing. They're tracking what happened on Wall Street. It's looking positive for a Fed rate cut, and that's why you're seeing a carpet of green very clearly, led, of course, by now the Kospi. Earlier, it was the Nikkei. You're seeing positivity returning to even the Shanghai Composite, which had gone into the red just a little bit. But a lot of developments are likely in Taiwan also, with the defense spending decision that has been ratified. So we are going to be watching this space for quick developments. But let's also give you a sense of what's happening in India. We're counting down to the market open. We're just about 15 minutes away from that. This is how we're shaping up GIFT Nifty futures. Currently, indicating a bit of a muted start. The Nifty 50 not in that range of 26,000 plus, down below. But remember, it has been a bit of a choppy and volatile session. The focus is also going to be on the US dollar-India rupee relationship. At this point in time, the Indian rupee further weakening against the US dollar, and whether the RBI intervenes or not, that's going to be weighing on the minds of many traders. Now, let's move on and give you a sense of something that we've been following very closely. Shares of India's V2 retail surging more than 80% in the past year. The fashion retail chain, geared towards the country's tier 2 and 3 cities, swung back to a profit in its most recent quarter, driven by strong revenue growth and expanding margins. And it's got an aggressive expansion plan, targeting about 100 new stores annually over the next few years. We have with us Akash Agarwal. He is the CEO and whole-time director of the company V2 Retail. Akash, it's a pleasure to have you on CNBC. I don't know where to start exactly because there's just so much to cover. But let's start with the stock price. It's up about more than 80% in the past year. What are you doing different? Because it's almost questionable whether you are the fastest growing company in India, but there is some data to suggest that you were in 2024, if not in 2025.
So if you look at the journey over the last 3 years, there has been a jump in the per store revenue per month from about 65 lakhs to more than 1 crore. So we have shown a 90% same store sales growth for those cohort of stores that we had at the end of FY23. And now in more than 90% of the locations, we are at least 30 to 35% higher in SPSF sales than any of our closest competitors. So we've been able to build a very strong model and a very clear competitive advantage.
Okay. When you talk about competitive advantage, it's important to note that while you're growing very fast, quarterly revenue was about, and you can correct me if I've got this slightly off, 709 crore. And Reliance Retail, which is a competitor, but a bigger competitor, it's at about 79,000 crore, so 111 times bigger. But here's the key. V2 Retail is growing 4.5 times faster. What I want to understand is, what's the strategy to keep this pace going?
So if you look at around the world, value fashion has really changed the complete landscape. Shein was the most downloaded app in the US. If you look at brands like Fashion Nova, you look at Primark. So the frequency of purchases has really shot up, especially with Gen Zs and millennials. So that is why people are more inclined towards buying more shirts in the fast fashion and a lower price point rather than buying a very expensive branded shirt that they wear for 6 months. So this has really played into our strengths. And we feel there is a capacity of having at least 2,000 to 2,500 V2 stores just in India. And if we are able to build a strong enough model, then why not expand throughout the world?
Okay, because I was going to ask you about that. At this point in time, you're domestic, and in a way, you can elaborate about your global expansion plans. But just tell us about tariffs, because one of the big parts of the tariff conversation in India has been that it's hurt the garment industry. But you're domestic. Is it possible that because of this tariff, you're getting an advantage?
So we've had more than 20 exporters come to our office over the last couple of months because they're losing orders from Europe and America, and they want to shift their business to domestic players. So I think it is actually benefiting us in a way because now we have more capacity that we can use for our own network of stores.
Right. But can you elaborate on that? 20 exporters, how many have you converted into deals?
So the thing is, we're still negotiating with them in price because their price standards or the benchmarks that they have set with American customers, it's very different to what the kind of cost control that we have. But we have already converted two of them. One is in Tirupur, one is in Ahmedabad. But hopefully in the near future, we'll be able to convert many more.
All right, we'll come back to you in just a bit, Akash. We need to just break away into what's happening in Taiwan. We're getting some pictures from a press conference, and in fact, we can see right now the Taiwanese President Lai Ching-te. He is speaking about effectively the proposal that has been ratified a short while back. He's announcing it officially, which is that they will be proposing a 40 billion in additional defense spending over several years. Now remember, if you just zoom out a little bit, what is going on? There is this island which is democratic, but you are seeing efforts domestically to deter a potential Chinese invasion. There has been a tension between Japan and China that has affected the markets. You are seeing at this point in time the Taiwanese markets remaining positive, and also you have just got a sense from the Taiwanese president about why they are doing this. He's saying that China is speeding up military preparations to take Taiwan by force. Remember, US President Donald Trump and President Xi of China also had a conversation about Taiwan where China restated its perspective. That is what we're hearing from the Taiwanese president. He's also said that China's infiltration and influence campaigns are intensifying in Taiwan. He says Beijing continues to increase military drills and gray zone harassment near Taiwan. Now, obviously, we're watching this space very closely. We're going to go back to Akash Agrawal and come back to you with more details about what he's actually said, the president of Taiwan. Akash, sorry about that interruption. Well, let's just come back to your story. Fascinating, really. This is zoom out. Let's go to the beginning, right? Because there was Vishal Mega Mart, which, in tier 2, tier 3 towns, people just storm there to get the discounts. With families, they go there and they shop. But V2 retail is slightly different. That's the next venture that your family has come up with. But your father started V2 retail, and you got the reins now as a CEO. What's changed in terms of strategy? Like, what's the fresh blood that you're bringing in? The new generation always gets something in. So tell us, what's your secret?
So the biggest change has been the business model itself. We did not have any product development. We did not have any product innovation. We did not have any in-house designing. So we were completely reliant and dependent on our vendors. Now, more than 35% of what we sell are designs that are designed completely in-house. No fabrics were nominated before. And in fact, we've increased the number of options that we offer to the customers. So earlier, it used to be around 1,200, 1,300 options. And now we do more than 3,000 options in a store. And we've also reduced our gross margin strategy. So all of these things have completely transformed the business, and we can see it in the numbers.
Okay. I don't know if you saw earlier, just about 10, 15 minutes ago, we were doing a segment on e-commerce and quick commerce, more on quick commerce. You have certain plans, and those have been questioned. Why go down that road when it's already so competitive, but you insist that you're going to do that?
So for e-commerce strategy, you need to understand that it's only to add additional channel to our existing customer base. So it's not to burn advertising costs to acquire customers. So we already have a customer base of more than 5 crore customers. So it's just to provide them convenience, because we have a network of 279 stores now, and we can easily leverage that same inventory without any additional fixed costs to service our existing customers if they want the clothes delivered at home.
All right, that's an interesting point. Omni-channel is your thought process, these ambitions. Talk to us a little bit about debt and liabilities. There's not much there right now on your balance sheet, but how efficiently can V2 turn inventory and sales into cash going forward? Because you have these grand ambitions going global, so many retail stores, 2,000 retail stores, without giving a timeline?
Yes, that's the ultimate target. That's the vision over the next decade. And the growth will completely depend on our performance. And we will keep accelerating our expansion if the performance continues.
So how do you handle the debt situation? It's going to come up because you raised about 400 crore. You will probably have to raise more, right?
So we raised 400 crores of equity. It helped us pay off all our debts. I think the only debt on the books is now 15 crores. So we are almost like debt free, you can say. But going forward, it's all about the ROE. If we keep delivering an ROE of more than 20%, then a very healthy debt to equity ratio is also quite good for the business. So in a couple of years, if we think that we want to accelerate our rate of expansion and we put on the books, you can see that.
Okay, just talk to me a little bit about the dominance in Tier 2, Tier 3. You're dominant in North and East India. You're making inroads in 5 other states, including, I believe, Andhra Pradesh and Karnataka. But the competition is much stiffer when you go to the Tier 1 cities, and you're planning to do that. I believe you have about 10 stores in Delhi. How competitive is that going to be? How are you going to win that race?
So we have 11 stores in Delhi now, and most of them are doing better than national average in terms of sales per square feet. So when you talk about competition, you need to segregate the price segment that we operate in. So there are not many national level players who operate in the same price segment. So our average selling price is about 300. So it is still a very vacuum market. It's very fragmented, mostly unorganized retail. So that is why we are seeing the kind of response we're seeing in whatever geography we're entering. So we entered Karnataka a few years back, and now we already have 18 stores in that state. So It's become a core, strong market for us.
Okay, Akash, it's been a pleasure, bringing your story. It's a domestic story, which is we've tapped into it early. We look forward to how people across the world look at it and your global expansion. And I'm sure you'll come back when you have those numbers for us and that success. Thanks so much for coming on, Akash Agarwal from V2 Retail. Okay, we're going to return to my colleague Emily Tan. Let's just get a sense of what's happening because the Taiwanese government is holding a press conference on defense spending. Emily, what are you learning?
We're hearing from President Lai Ching-te right now, Amitabh. He is the gentleman that you can see in the screen there. The government holding a press conference this morning on national security. Now, some strong statements that are coming through from Taiwan's president. He says that Beijing has been trying to turn democratic Taiwan into China's Taiwan, that China threats to the Indo-Pacific are intensifying, Beijing continuing to increase military drills and gray zone harassment near Taiwan, and that China's infiltration and influence campaigns are intensifying in Taiwan. China is speeding up military preparations to take Taiwan by force, to set up mechanisms to counter China's transnational repression and protect Taiwan's citizens. The Taiwan president says that one country, two systems is a red line for Taiwan, and that Taiwan will adopt strategy to self-defense to counter Chinese threats. They're going to achieve a high level of combat preparedness by 2027 and aiming to improve military procurement process. Now, these lines coming through from President Lai Ching-te in Taiwan. Now, just to put this into context, this comes after and in response to the back and forth between Taiwan and China. First, I should say it's in Japan. The new Prime Minister, Sanai Takaichi, had made some recent remarks over how Japan might respond to a Chinese attack on Taiwan. That resulted in a strong rebuke from that of China, and then that followed on with a phone call between President Trump and President Xi, and then following just hours after that, that was just yesterday, a phone call between President Trump and Prime Minister Takaichi. Now with that, we are seeing the government in Taiwan having response and responding to the back and forth between Japan and China, and accusations now by President Lai Ching-te saying that China is threatening the Indo-Pacific region. Those threats are intensifying, and Beijing has been trying to turn democratic Taiwan into China's Taiwan. So this is all we know in the national security press conference that he is currently holding, that Taiwan is looking to improve their military procurement process. They're looking to achieve a high level of combat preparedness by 2027, and they're looking to adopt a strategy of self-defense to counter China's threats. He also goes on to talk about the one country, two systems, and that is the system that we use here in Hong Kong, as well as over in Macau since the handover, and that is a red line for the island. We are watching the Taiwan market, not reacting to the latest developments here or the comments coming through from the president, higher by 1.3%, and we're looking at the Taiwan dollar against the greenback, last traded at 31.33. Amitaj.
Emily, there's a lot happening. Let's just put this in context a bit more, because we did have Scott Bessent earlier on CNBC. He was asked a question by one of our colleagues. The question was simple: has the position on Taiwan changed for the U.S.? And his answer was, it's not, it is what it was. But there's also been this call with, between Donald Trump, the president of the US, and President Xi of China. And President Xi made it clear that, Taiwan is their objective, effectively. Has Taiwan now reached a tipping point globally, the issue?
It is very interesting because when we were listening to Scott Bessent and what he had said that nothing has changed, well, it has never been clear the Trump administration's stance on Taiwan, whether it's this strategic ambiguity or the strategic certainty. It was very different under President Biden, where we had the trade, almost like a trade deal or a trade framework that was established between Taiwan and the United States. That has since stopped. It's no longer as warm and as close in terms of the trade deal or the trade tariff that the United States has put on Taiwan. That stands at 20%, and the island is continuing to talk that down. Everything except semiconductors is in that 20%. So that is a very important industry that President Trump, of course, is working on as well. But it is not very, very clear as to the stance that the United States has on Taiwan. That was all that Scott Bessent would say when he was answering the question on a U.S. Squawk Box just last night. As far as what was also very clear and apparent was this phone call between President Trump and President Xi. In the readout after the call, President Trump mentioned, what was it, soybeans, and talking about a various number of things, Ukraine, in their talks between the two presidents. But Taiwan was not mentioned in his social media post. But on the Chinese side, coming through from Xinhua and the foreign ministry, talking about Taiwan, that China reiterated that this was an important, China's stance was very important when it comes to the topic of Taiwan, and it was discussed between the two, but the fact that President Trump did not mention it also is something worth noting. So we are watching the press conference by President Lai Ching-te in response to the back and forth between China and Japan following the comments from Japanese Prime Minister Takaichi. And just to recap here, what she had said is that if there were to be some sort of a response by Japan, if China were to try and take back Taiwan. Amitaj.
All right, Emily, we'll obviously come back to you with more perspective as announcements continue to come from Taiwan. Now, Indian markets, they're online. They've been online for just a few minutes. It's looking green. Nifty 50 just up 0.26%. The 26,000 barrier, really, it's where the flirtations have been going on for a while now. And remember, in September 2024, we had the high of 26,200 plus. That's not something that it's looking will be hit. Today, the rupee, once again, slightly down against the US dollar. We're watching whether the RBI will intervene, although nothing official ever comes out regarding that. Traders are watching that space to get a sense of what really happens. Okay, that's what's going on with the markets, but what else could really move the movers in the, what could move the Indian markets today? Let's take a look. Tata Motors has launched the mid-size Sierra SUV, reviving a decades-old cult brand to take on rivals like Hyundai Motor and Maruti Suzuki. It was a big car back in the day. Now Tata has boosted its market share to over 13%, up from 5% in 2019, thanks to safety ratings and a strong push into EVs. But competition is intense, with Mahindra and Mahindra also rolling out SUV designs and Hyundai dominating value segments. Now, Tata and Mahindra are battling to dislodge Hyundai from the number 2 spot in a market that is still led by Maruti Suzuki. The shares, as you can see, Hyundai Motor down 0.73%, the rest of them up, and Tata Motor up quite heavily, 2.3%. All right, ACL Technologies has announced a strategic partnership with Amazon Web Services aiming to accelerate digital transformation in the financial services sector through autonomous AI-powered solutions. The partnership will combine the HCL Tech's domain expertise with AWS technology to deliver innovative outcomes for banks, insurers, and wealth management firms. As part of the initiative, HCL Tech plans to roll out a suite of pre-built industry-compliant solutions designed to modernize contact centers, enhance digital engagement, and streamline core platforms across banking, wealth, and insurance. The shares right now are 0.68%. Now, global cargo, if you can move on, is moving differently these days as tariffs continue to take a toll. But some companies are weathering the storm better than others. CNBC's Monica Petrelli has more, and she's right here with me. Monica?
Some companies saying actually business is thriving, and one of those is SAT. So this is a Singaporean-based company that is now fresh off 2 consecutive quarters of record-breaking air cargo. It's also, in its most recent earnings, putting up operating profit of about 24% year on year. And this is huge because it says this is happening because of the growth in air cargo. Now, SATs, most people that are familiar with this tend to think of this in terms of food. It started out as a subsidiary of Singapore Airlines. So SAT's growth story really following Singapore Airlines' growth story. However, Sing Air divested its stake in the company some 15 years ago, which allowed it to then take on all these new clients. So if you fly in Asia Pacific, chances are you have eaten a SAT's prepared meal. But now, the company deriving more than 50% of its revenue from cargo. That's because it learned a lesson during COVID. Well, people stopped flying, but stuff doesn't. As cargo continued to thrive during the pandemic, as people sat at home and purchased things on their computers, SATs decided to make a big purchase. WFS, this is an example not of a big fish taking on the little fish, but of the little one taking on the biggest company. In fact, WFS, one of the, if not largest, air cargo handlers in the world, now an accolade that SATS enjoys. So I sat down this week to talk to President and CEO Kerry Mock from SATS about the company's air cargo growth and also how it's using AI to get ahead, but not in a way that you might expect. Take a listen.
We saw cargo into the US dropping, but cargo to the rest of the world continues to grow. And the big surprise for us has been the growth of Europe. We're seeing double-digit growth out of Europe itself. And in Asia, we're seeing about 78% growth, Asia and Middle East. So when you look at China, I mean, China obviously is a big topic for many people. China's overall trade has grown as well. So very interestingly, cargo finds its way and continues to drive the growth for many of the countries around the world. I think there are a few other factors that's, I think, helping that beyond just the front loading. The rise of AI is a very important aspect, and many of AI companies, where they're buying equipment, capital equipment, or they're buying, set up data centers, server racks, these are all going on air freight. They're not on ocean freight. So that's going to give us another push as well. And of course, e-commerce, you cannot ignore e-commerce. Yes, overall e-commerce in the US has dropped because of the removal of de minimis, but into Europe and into Latin America, it's still going very strongly. And we don't foresee that dropping. I think it's also a function of people's lifestyle. If you're into TikTok, Instagram, you want the item straight away, air is the only way you're going to get that items faster than any other modes of transport. So we believe a little bit of tailwind in that will continue to keep the demand for air cargo strong.
And with the downturn in trade going into the U.S. or to North America, and you noted the growth to the other regions, is it enough to offset that downturn?
So interestingly, as an overall volume, as a group, we have seen increase. So in fact, the last 2 quarters has been record quarters for us in terms of cargo volume. So we're seeing that still going strong. And as we move in the 3rd quarter, which is our traditional year-end peak, touch wood, things seems to be moving on fine. We're still seeing good numbers coming from the different regions. So we believe that's still going to continue to help us drive that growth. I think the one thing that we will be concerned with is if inflation is going to hit the US? Is that going to slow down overall demand, the economy? Is that going to have a knock-on impact on the rest of the world? That is something we are obviously watching. And if overall GDP slows down, then air cargo will be affected. Again, that's something that we will watch very closely as we navigate through different challenges. It's been up and down throughout, so I think we're in a good position to continue to ride on that.
And I want to talk about the very near future first, and that's the upcoming holiday season. So for a lot of people, this is a very busy, expensive time to fly. What is the holiday peak season like at SATS? And will this year be any different than years past?
This year, I would say in Asia Pac, we are seeing increased numbers. In fact, Singapore, which I think the Ministry of Transport just announced that the numbers year to date is higher than last year. So we are seeing increased travel out of Singapore, and which means there's more food that needs to be served. We have the capacity, we have the ability, and we have the playbook to actually handle all these. In fact, next week, there's going to be 2 concerts being held here in Singapore. One is Blackpink, and then the Jackie Chun concert. We are also supporting the food for that event as well. So and then plus the cruise center, we're going to have ships coming in, 2 large cruises coming at the same time. So I think if I look back, we are very good at managing big scale events. And I think that's one of SAT's core strength as a company.
Now that's just a small snippet of a larger report that we'll be bringing you about how SAT's transformed from a Singapore company to a regional player to a global powerhouse in air cargo. But Amitoj, we will take you into the kitchens, show you how they produce around 120,000 meals a day.
Oh my God, that's going to be dangerous. I'll keep eating the food. But we got to go now, guys. This was Inside India. Keep watching CNBC. Monica and I, we're going to go and book those tickets for Blackpink.